morning, everyone. I'd like to thank everyone for attending our graduation project. Today, we're going to be talking about the impact of loss aversion and overconfidence on firm market performance by Dr. Heba Srour, Ahmed Abdelghay, Nouran Diaa, Yomna Sherif, Nouran Osman, and Salma Khaled. The traditional theory is based on the traditional finance theory is based on the concept that investors act rationally. Their aim is to maximize profit, and they are usually risk averse. The behavioral theory of finance is based on two basic assumptions. The first is that investors are not fully rational in the sense that their demand of risky financial assets is influenced by emotions as well as beliefs. The graduation project aims to investigate the impact of behavioral bias, of two behavioral biases, namely loss aversion and overconfidence, on the performance of Egyptian companies. First, the impact of loss aversion on the market performance. Second, the impact of overconfidence on market performance. Return on assets refers to the ratio that indicates how profitable a company is in relation to its total assets and is calculated by dividing a company's net income by its total assets, whereas return on equity is considered a gauge of a corporation's profitability and how efficient it is in generating profits and is calculated by dividing net income by shareholders' equity. And now we're going to continue with my colleague, Nouran.
Thank you, Ahmed. For the methodology, let's start with the research question, which is, what is the impact of the investors of aversion and overconfidence on a fair market performance? Then moving to the research objectives, we have stated three main research objectives, which are to understand the impact of opposite effect of the investors' loss aversion and overconfidence on the firm performance, to contribute to support the firm in understanding the effect of loss aversion and overconfidence, and finally to achieve the SDG goals, Sustainable Development Goals issued by the United Nations for 2023. The fourth goal for the quality education by applying the scientific research methodology, and the eighth goal by providing business owners with recommendations and to increase economic growth and improve work environment. Then for the research hypothesis, we have a main hypothesis, which is there is no impact for loss aversion and overconfidence on a firm market performance, and two sub-hypotheses, which are H1A, there is no statistically significant impact between the loss aversion and the overconfidence on a firm performance measured by return on assets. H1B, there is no statistically significant impact between the loss aversion and overconfidence to the firm performance measured by return on equity. Finally, for the studied sample, we have used quantitative method to collect our secondary data from the financial statements and the annual stock reports of 23 companies from the period of 2013 to 2018. They are all listed on the EGX 30. We also use a multiple regression model to assess the impact of loss aversion and overconfidence on a firm market performance. We have established two models for our dependent variables, the return on assets and return on equity. Moving to our result. Finally, from the previous models, we can tell that overconfidence and market capitalization have a negative impact on the return on assets and return on equity, while loss aversion, net earning, and token skew have a positive impact on the return on assets and return on equity. Then finally, all dependent variables here are statistically significant impact on return on assets and return on equity, where the multiple regression equations prove that rejection of the null hypothesis and the acceptance of alternative hypothesis. Back to Ahmed for the conclusion.
Thank you, Nouran. Basically, we have reached the conclusion that our graduation project has reached the conclusion that both behavioral factors affect the firm's market performance. Overconfidence has a negative relationship on return on assets and return on equity, while loss aversion had a positive relationship on return on assets and return on equity. The limitations that we have faced was a time constraint, and secondly, it was a geographical constraint. Lastly, I would like to acknowledge and thank our Dr. Heba Srour for her significant support and insight, the help that she has given us throughout the years and our graduation project. And I would also like to thank everyone who has attended the conference. Thank you for attending, and I would like to express our extreme gratitude and happiness being a part of this. Thank you so much.